Let's go back to 1950. Your grandfather gets home from his job at the factory. He makes $3,000 a year. That's about $36,000 in today's money. The average house costs $9,000. Do the math. That's 3 years of income for a lifetime asset. But here's the beautiful part. He doesn't need perfect credit. He doesn't need a 20% down payment. The FHA insures his loan, so the bank is happy to lend. The VA gives him an even better deal if he's a veteran. The government isn't picking winners and losers. It's ensuring everyone has a fair chance. And college? Most state universities charge less than $500 a year in tuition. That's about $6,000 in today's money. Your grandmother could literally work a summer job and pay for her entire education. Not just tuition, room, board, books, everything. This wasn't socialism. This was smart capitalism. When regular people have money to spend, the entire economy grows. When education is affordable, you get more doctors, engineers, and teachers. When housing is accessible, families build wealth and stability. The system worked so well that by 1970, America had the largest middle class in human history. Income inequality was at its lowest point ever. Social mobility was real. Kids from poor families regularly became middle class, and middle class kids could reach the top. But there was a problem. If regular people could afford homes and education without incurring massive debt, how were financial institutions supposed to make massive profits? The answer: destroy the system and rebuild it in their favor. January 20th, 1981, Ronald Reagan takes the oath of office and delivers a line that would change everything. Government is not the solution to our problem. Government is the problem. At that moment, mortgage rates were at 18.45%, the highest in American history. Inflation was crushing families. The economy was in shambles. Reagan's solution? Get the government out of the way and let the free market work its magic. What happened next wasn't magic. It was calculated destruction. The first policy change, 1982. The Alternative Mortgage Transaction Parity Act. Sounds pretty technical, right? This law allowed financial products that had been restricted since the Great Depression. Adjustable rate mortgages, where your payment could increase significantly. Balloon payments, where you owe a large lump sum at the end. Interest-only loans, where you never actually pay down the principal. The major change, 1986. Tax Reform Act of 1986. Reagan called it simplification, but for real estate investment, it created significant changes. They extended depreciation schedules from 19 years to 27.5 years, reducing the tax benefits for rental property investors. They raised capital gains taxes from 20% to 28%. They created passive loss rules that limited real estate investors' ability to deduct losses against other income. The result was clear: investment in affordable housing became less attractive, and the market responded. Multifamily housing construction, the apartments and condos, where young people typically get started, dropped by 73%. In 1985, builders started 515,000 multifamily units. By 1991, it was down to 140,000. That's not just a market shift. That's a policy-driven outcome. The system intentionally stopped building the exact type of starter homes young generations need nearly 40 years ago. This is the structural genesis of the current problem. But here's the cover story today. Politicians and the media tell you the crisis is solely due to bad local zoning. Local zoning is certainly a bottleneck, but it became the dominant bottleneck only after federal policy made building affordable units a financial dead end nationwide. They removed the incentive to build affordable housing, then blamed local governments for blocking what no one was incentivized to build anyway. That's not just a market shift. That's a policy-driven outcome. Before 1982, these were restricted because they were considered risky for consumers. After 1982, they became widespread and eventually formed the foundation of the subprime mortgage market that contributed to the 2008 financial crisis. Between 1998 and 2008, the financial industry spent $5 billion on lobbying and campaign contributions. They advocated for more deregulation, more complex financial products, and more ways to profit from basic services like housing. Their advocacy was highly effective. This wasn't incompetence or an unintended consequence. This was a deliberate shift in policy priorities. From helping regular families to facilitating financial innovation, the evidence: by 2006, 90% of subprime mortgages used those same adjustable rate products that became legal in 1982. The foundation of the 2008 financial crisis was built decades earlier through specific policy changes. The system collapsed. The 1990s and 2000s weren't just about housing bubbles and financial innovation. They were about to complete the transformation from a system that served families to one that served financiers. The securitization innovation. Here's how it used to work. Your local bank gave you a mortgage and kept it on its books. If you couldn't pay, they faced the loss. So they had strong incentives to make sure you could actually afford the loan. Here's how it evolved. A mortgage company gives you a loan, then sells it to Wall Street, where it gets packaged and sold to investors worldwide. The original lender keeps the fees but transfers the risk. What happened next was predictable. Between 1996 and 2007, mortgage-backed securities grew from $1 trillion to $7.3 trillion. The global economy became heavily dependent on American mortgage debt. Glass-Steagall-Dares, 1999. For 66 years, the Glass-Steagall Act kept commercial banks separate from investment banks. Your local bank couldn't gamble your deposits on risky Wall Street bets. In 1999, Congress repealed the key provisions. Suddenly, the same institution holding your checking account was also creating complex derivatives and making billion-dollar bets on housing prices. The firewall between safe banking and casino capitalism was gone. The subprime explosion. In 2001, subprime mortgages made up 15% of all new loans. By 2006, it was 48%. Banks were literally giving loans to people with no income, no job, and no assets, the infamous ninja loans. Why? Because they weren't keeping the loans. They were selling them to Wall Street as fast as they could originate them. The worse the loan, the higher the fees. The inevitable crash. Housing prices peaked in 2006. By 2007, Bear Stearns hedge funds were imploding. By 2008, the global financial system was in freefall. Lehman Brothers collapsed. AIG needed a $185 billion bailout. Millions lost their homes, their jobs, their retirement savings. But here's the real crime. The people who caused the crisis got bailed out. The people who suffered from it got foreclosed on. Building the student debt prison. While the housing crisis was destroying homeownership dreams, another scheme was quietly trapping an entire generation in debt slavery. The college cost explosion. In 1980, the average cost of college was $10,500 per year in today's dollars. By 2020, it was $35,000. That's not inflation, that's extraction. What changed? Federal student loans. Here's the con. The government makes it easier to borrow money for college. Colleges respond by raising prices to capture that borrowing capacity. Students end up paying more, not less. It's the same scam as healthcare. When insurance pays, prices go up. When the government pays, prices really go up. The bankruptcy change. In 2005, Congress passed legislation making student loans much more difficult to discharge in bankruptcy. This wasn't random, it was advocated for by the lending industry. Now you can discharge credit card debt, medical debt, even certain business debts in bankruptcy. But student loans? You're typically responsible for them regardless. This created a low-risk environment for lenders. They could provide loans to almost anyone for any degree because repayment was essentially guaranteed. The current crisis. Today, Americans owe $1.7 trillion in student debt. The average borrower owes $39,000, but for many it's much worse. Graduate students, the doctors, lawyers, and other professionals we supposedly need often owe $100,000, $200,000 or more. These are people who did everything right, worked hard, got advanced degrees, and are now financial prisoners. Meanwhile, colleges are spending millions on luxury dorms, administrative bloat in athletic programs, while professors are replaced with adjuncts making poverty wages. The current battlefield. Here's where we stand today, and it's worse than you think. The median home price is now 8 to 12 times median income in most major cities. In expensive markets like San Francisco and New York, it's 15 to 20 times. This represents a significant change from historical affordability ratios. The housing market has evolved from primarily serving basic shelter needs to functioning as an investment asset class. Meanwhile, rental costs often consume 30% to 50% of young people's income. This makes saving for a down payment particularly challenging. Education, the debt factory. College costs continue to rise faster than inflation, faster than wages, faster than everything except healthcare. Students are taking on more debt for degrees that provide less economic value. The pandemic made it worse. Remote learning proved that much of higher education is overpriced and unnecessary, but costs didn't go down. They went up. Many graduates now owe more after 5 years of payments than they borrowed originally, thanks to income-driven repayment plans that don't even cover interest. This perpetual cycle of indebtedness, where the principal never shrinks, is the mechanism by which the financial sector extracts generational wealth. It is the core function of the financial Mobius strip. The wealth dynamics. What we're seeing is one of the largest upward transfers of wealth in modern history. Young people pay rent to property owners, student loan payments to financial institutions, and face higher prices across the board, despite having limited political influence. Meanwhile, older generations who benefited from cheaper housing and education often don't fully understand why younger people face such different economic conditions. The political response. Both parties offer different approaches. Republicans often emphasize reducing government intervention. Democrats typically propose increasing government intervention. However, neither fully addresses the core issue, the financial system's significant influence on policymaking. Student loan forgiveness programs sound helpful, but they don't address colleges raising prices. Housing subsidies sound beneficial, but they often increase demand without increasing supply. Effective solutions would require directly addressing financial industry practices. And that's where the political conversation becomes more limited. The information gap. Here's what's interesting. You've probably never seen this story presented this way in mainstream media. There might be good reasons for that. Economic incentives. Who advertises on television and funds major media? Banks, real estate companies, student loan servicers, universities. These are the same institutions that benefit from the current housing and education market structure. It would be unusual for them to fund programming that questions their business models. The complexity factor. Mainstream media often presents these issues as complex, requiring nuanced discussion. But actually, the core story is pretty straightforward. Government policies used to make housing and education more accessible for regular people. Those policies were changed in ways that made these services more profitable for financial institutions. Now, regular people find housing and education less accessible. That's not particularly complex. It's cause and effect, content priorities. Media tends to focus on culture wars, celebrity stories, and political drama. These topics generate engagement and don't threaten advertising relationships. They spend hours analyzing social media posts, but rarely explain why economic conditions have changed so dramatically for younger generations. Global context. This pattern isn't universal. Germany maintains affordable housing and free higher education. So do Denmark, Norway, and South Korea. Many developed countries do. The difference often comes down to how much influence financial institutions have over policymaking in each country. The digital information shift. But something is changing. Young people increasingly get their news from TikTok, YouTube, podcasts, and other platforms where creators can speak more freely about economic issues. This is why these platforms often face criticism from traditional media and some politicians. They represent a shift in who controls information flow. What this really represents. This isn't just about housing or education policy. It's about democratic participation. When financial interests can reshape major sectors of the economy, while public discussion remains limited, that creates challenges for representative democracy. The question becomes, how do citizens make informed choices about economic policy? Let's be honest. There is no single magic answer that will solve this overnight, but you have a power far greater than anything they possess. It is the ultimate leveraged time in youth. Wishing for good results without effort, or just waiting for someone else to fix it, that's throwing away your greatest privilege. It's time to stop being the employee who blames the system and become the principal who exploits it. Shift your position. You have to coldly analyze and evaluate yourself. Look at the entrepreneurs who succeeded young. They didn't just work harder, they used capital and legal structure to control the system. The system has trapped you in the employee class. You must break that barrier. Start a small side venture, a one-person company or freelance work. It doesn't matter how small. Use that activity to create the owner's position that grants you the system's legal shield. This position is what legally and strategically empowers you to use the system against itself. Steal the three weapons. These three tactics are the most practical and subtle ways to protect your assets and turn the system's logic against them. Steal the three weapons. First, compelled capital arbitrage, exploit their obligation. The weapon bank regulatory duties, CRA. The big banks and financial institutions are compelled by regulation, like the Community Reinvestment Act, to put cheap capital into low and moderate income markets. This isn't their kindness. It's capital forced out to protect their own privilege. You must find this money. Look for CRA-backed mortgages or Government-supported low-income housing tax credit (LHTC) projects. Action hunt down community development financial institutions. CDFIs and seize the capital they are forced to release for your home purchase. Second, the ultimate leverage heist, steal their weapon. The weapon, government-backed debt and asset deduction. The key to the wealthy building fortunes is using other people's money OPM. Your small savings account is not the weapon to win this fight. You must steal their real weapon, real estate leverage. Use FHA or VA loans to leverage the cheapest debt, government-backed debt, and acquire an asset. A home with the minimum down payment. Once you acquire that asset, use the mortgage, interest, and property tax deductions to erect the largest tax shield the system permits. Action prioritize this fast, powerful conversion of debt into an asset. Use your small tax-advantaged accounts, such as a 401k and IRA, only as a minimal shield. Third, the Asset Shield LLC. The Asset Shield steal their legal protection. The weapon, limited liability and expert counsel. For the sophisticated operator, the primary purpose of an LLC is not the tax write-off. It is acquiring the legal shield of limited liability to protect personal assets. The wealthy hide all high-risk assets and activities behind a separate legal entity, LLC corporation. Use your self-directed income activity to establish an LLC. This creates a firewall that separates your personal assets, your home, savings from potential business liabilities or lawsuits. Warning and action. This shield is dangerous if used incorrectly. You must strictly separate no commingling business and personal funds and meticulously document all legal procedures with the help of trusted professionals, CPAs, or attorneys. This is a strategy to defend your wealth from systemic risk, not just to build it. The first step toward reclaiming what was stolen is not in shouting at the system, but in strategically exploiting its own rules and the compulsory obligations of the powerful to minimize their profit and survive long enough to change the game.
Why the hell is it always me?
Thank you sincerely for watching. If you have any questions about the topics we covered, or if there is a strategy you'd like us to explore in depth, please leave a comment below. We sincerely root for your wise, strategic survival. We hope this content serves as your first shield. Thank you.
Neighbors fighting every damn night, can't even sleep.